Logically's Coffee Break. I'm Lindsay Toole, Head of Sales at Logically, and I'm excited to be here with Joanna Gallegos, co-founder of BondBlocks and the architect behind over 175 leading ETF products. Some people even call her the mother of ETFs. Before joining BondBlocks, Joanna served in a variety of roles as an inaugural member of the management team brought on to build out the ETF business at JP Morgan. Roles including head of its US ETF business and head of global ETF strategy. And prior to JP Morgan, she served in a variety of roles at BlackRock iShares division, which I'm sure you guys are all familiar with. And Joanna, like myself, is an active member of Women in ETFs, where our mission is to connect, inspire, and support. So today we're going to try to do a little bit of that in our conversation. So we'll discuss BondBlocks' mission, Joanna's fascinating journey in the financial industry, and her expert insights into the future of fixed income ETFs. So grab your coffee, sit back, and get ready to be inspired. So in honor of Women's History Month, I kind of want to start out with some personal questions first, if that's okay.
Sure.
So as a woman, or as women, we often face unique challenges in the workplace. And having a network of other women who understand those challenges and can offer support and guidance is invaluable. So as a respected figure in our industry, what's a leadership lesson that you have learned that's unique to being a female leader?
I think I've had this conversation multiple times with many of my colleagues, friends in the industry, direct reports, and this would be with men and women, I would say, this is true. But in particular, maybe I think generally, I think women need to know one thing throughout the journey of their career. They need to know their number. So I don't want it to boil it down to just numbers, but as anyone that knows me, I'm very much about connecting with the value of my work. And as I've been part of businesses that grew to be, an amazing innovation in asset management, I've always been part of hyper growth businesses. I watched revenue, just sort of magically be created in a very short period of time in the ETF industry's history. I really wanted to always be connected with the value of those businesses. And to do that along the way, I had to really know my number. And it's another version of saying, know your worth. So one of the things that I've done many times is help people when they're negotiating for a job or a promotion, or they're just sort of feeling frustrated in their current role of okay, well, let's go through, what do you think that's worth to you? And sometimes it's not about a number. Sometimes it's about, I want more time to, I don't want to work 80 hours a week anymore. There may be something of scaling down and feeling nervous about coming to a boss and saying, this is what I want. So some version of that is as a leader and helping people get through those periods of, I think, real fear about, their next step, their next job is really check in with yourself, know what that number is. Maybe it's a number of salary or bonus or whatever it is, or maybe it's I know what my value is, and this is the way I want to feel my impact every day. But that's sort of the thing I think I've learned over time is checking in with yourself and really knowing where you're at, so that when the next opportunity comes to you, or you're in a place where you need to reposition yourself within your firm, or even competitively, you're competing with a colleague, you really got to check in with yourself on your self-worth and the value you're trying to connect with your work every day, because it's a lot of work. This industry demands a lot of our time, and you should be careful with your own personal time.
No, absolutely. That is really invaluable advice. I totally agree with you. Know your number, know your worth, and it doesn't have to mean your salary. It can mean your balance of life. Do you want to work from home some days, et cetera. So I think that is really good advice. So thank you for sharing, and it really does segue into my next question. So we all understand that it's hard to start a company, right? It's never easy, especially while balancing time, financial stability, other factors. So what are some of the personal sacrifices that you've had to make in your career to get to where you are?
Yeah, so I think I got this really early on in my career. I know some of my colleagues that might be on the phone remember this, but I think a really senior career coach, or I think it was a consultant that we were working with at one of the firms I worked with, said that like you really should be advancing yourself every 2 to 3 years. Like you should work really hard in those 2 to 3 year spans in your new roles, and like it'll just naturally create progression in your career. I was really fortunate that I kind of look up every 2 to 3 years and have to make another choice of doubling down on the trajectory I've been in. And it's been very fast and it's been very fortunate. And so the personal sacrifices that I think I've made are, you know, with my partner, with my husband, who wasn't always my husband. Sometimes he was, you know, my boyfriend. And, you know, we're talking about moving across the country for a job. Like I think like putting one of our careers first for a while, you know, does invariably mean you're making some trade-offs and choices. And so along the way, for me, it's like I think about what those personal sacrifices are. Probably every 2 to 3 years, where I re-up my commitment to the trajectory I'm on. Is it, again, I check in with myself. Is it the thing I want? Is it giving me value every day, both at home and at work? And then how is it affecting my personal life with, you know, in my case at the time, even when I was single or when I had my boyfriend or we were engaged or we're married, there were really big decisions that you make when you commit to financial services and you commit to a career of growth and advancement. And, you know, I kind of frame it in that 2 to 3 year standpoint, and kind of re-signing your personal contract with yourself.
Yeah. Oh, I like that. Personal contract with yourself. I got to use that.
Yeah. There's a whole bunch of trade-offs when you do that, but it's basically you get to pause and think like, okay, I'm consciously making this decision about these trade-offs and I'm going to go forward with it. So sometimes for me, it was location. Sometimes I moved. Sometimes it was, you know, travel. Oh, you're going to have to travel 2, 3, 4 times a month for this role. And you know, you've got to check in with yourself as much as possible. Make sure you feel okay about it.
Yeah, no, thank you. That's great advice as well. So I appreciate your candor and being honest with us.
Yep.
So now let's turn the page and talk a little bit about BondBlocks. You know, BondBlocks has been super exciting to watch. I mean, you guys came out with a few funds and now there's 19 and roadmap for more, just launching in October of 21. You know, the idea, your mission was really to provide precision ETF exposure to fixed income investors, right? You've previously shared that the markets have been incredibly underserved in terms of this precise exposure, and there aren't enough tools for investors to take action, you know, in these fixed income markets. So could you tell us more about the mission behind BondBlocks and then what inspired you to help co-found the company?
Yeah, I mean, you almost did it for me, Lindsay, but the founders of BondBlocks had a lot of experience in building out the fixed income product offering in ETFs since 2002. So we kind of were experts in this space of the way the ETF started to interact with fixed income markets, and there's just a ton of potential. We all kind of went off to other jobs post iShares. I went to JP Morgan. My other co-founder went to Goldman Sachs, Northern Trust, and we were kind of like building other businesses around ETFs for about 5 to 8 years. But you just kind of keep coming back to this problem set of like the fixed income ETFs should be such a bigger part of portfolios. They're so useful for fixed income markets in financial downturns like the Great Financial Crisis, the pandemic, different types of flash events, and between then and other types of market stress. The ETF is just always the first port of call in fixed income for liquidity. And it's grown so much over 20 years to be able to show people exactly how a market's transacting. And big institutional investors rely on that transparency. And, you know, what's fascinating about fixed income is it's an over-the-counter market. There wasn't a lot of trading technology that connected the market so that, you know, all investors could reduce costs and see where things were, where their markets were with their clients. They couldn't really negotiate fees as well as they can. And that's changed just in the fixed income markets too. So there's this like beautiful intersection. It's sort of the right time to add more product sets to the fixed income market. The fixed income infrastructure is modernizing. So investors get to see a lot more of like exactly how they're transacting, what the underlying costs are. And ETFs are have been a really important part of that story. And we wanted to accelerate the growth of that. And if you don't focus on something and do, I very affectionately call it the City Slickers strategy, where like we do one thing, we do fixed income. So we think about fixed income investors, we think about the fixed income market, we think about the problem sets that are unique to fixed income investors, and we invest in that so that we can get that right and really understand those use cases. If you didn't focus on it that way, it gets lost in a lot of other priorities. And we think that the investors have been underserved by that because there hasn't been an ETF, an ETF provider that has done that yet.
Yeah, that's great. And, you know, to the name of the company, bond blocks, right? ETFs are building blocks, and you're talking about, you know, fixed income building blocks. So I like that a lot. And, you know, as we close out the first quarter, I cannot believe it, this new year, the demand for fixed income investments, you know, continues to remain strong, particularly as investors look to diversify in their portfolios and manage risk. So what do you believe the outcome will be for fixed income in 2023, and why do you strongly believe in this? And in your opinion, what sets bond blocks apart from the other fixed income ETFs in the market? You kind of spoke to that a bit, but maybe just kind of comment on where you think we're going.
This quarter has had different expectations week from week. So really centering in on exactly what the consensus is from the economic data, whether it's inflation or it's jobs or it's, you know, stability in the financial system. It's been really hard to pay attention. I quoted this yesterday on Bloomberg Radio that, you know, our portfolio manager considers like the space for fixed income has just been a lot of red lights, green lights, red lights, green lights. Like there's been tons of volatility in treasuries in the last few weeks. So what I think is the actual outcome for 2023 is, if you zoom way back out, is that more portfolios are going to be allocated towards fixed income, because these yields have historically grown at a rate that we've never seen in 1 year. It's the biggest percentage rate of interest rate increases. And you have to really just understand that, you know, bonds have changed in just 1 year's time to be incredible contributors to your portfolio return for 2023. So if investors are paying attention to that, the truest outcome of 2023 for fixed income is that people will use the power of the yield and interest that we can now get access to in their portfolios to get positive return this year. Even if, you know, you think about, you know, potentially rates decreasing by the end of the year and price return in bonds going down, or, you know, we kind of think of it, we've just been described as like a sideways market. If things are flat this year, at the very least, you have income from fixed income that just didn't exist 18 months ago. So 2023 should be all about carry, yield, income, call it what you want, coupon, to power your portfolio. There obviously the scenario analysis of whether, you know, we're going to see an economic downturn and there'd be like distress in fixed income. Like we haven't seen that yet. Spreads in fixed income are at their historical averages pre-recession. They survived all of 2023 without, you know, showing a big widening of spreads that people would expect, you know, should have been 2-3 times what they ended up being last year. So it's really kind of tough to say that fixed income isn't a big place of opportunity for 2023.
Right. Yeah. And it's clear that you guys are really kind of disrupting the fixed income space. And, you know, then these fixed income ETFs will continue to grow in popularity, especially, you know, as investors are looking for this low cost kind of liquid way to access this. And, you know, technology plays a pivotal role in all this. So how do you see the fixed income ETF space evolving over the next 5 to 10 years? And what role do you see bond blocks playing in that evolution?
Bond blocks' primary mission, as we talked about, is to be focused on fixed income. So we hope over the next 5 to 10 years that we've done a great job of calling attention to the way that fixed income is more accessible to investors, more transparent to investors, and also more cost efficient to investors. I mean, that's just sort of the ETF trifecta right there. So bond blocks will contribute a lot more product opportunity for clients. We'll launch, you know, we have a really robust product launch plan over the next 4 to 5 years. We'll add more choices to the market for clients. But in technology perspective, you know, what's happening to the fixed income markets right now is very similar to what happened to the equity markets 20, 25 years ago, where equity markets started to digitize, they started to modernize. I go to the New York Stock Exchange almost once a month, and it's the quietest floor ever. I, in my career, have been on stock exchanges where there was an actual pit and a specialist standing up, and there were brokers running around the floor. But that was 20 years ago. And what's happening in fixed income is similar. It's really effective trading tools on platforms now for large fixed income investors to interact with multiple brokers at once. So that digitization, that modernization, and then the modularity of buying big baskets and big portfolios of bond at once. That's called portfolio trading. In fixed income has skyrocketed in growth. I always want to remind people that the very first portfolio trade, which is again a basket of bonds and transacting them between two parties and at a standardized price, was the ETF, and that was 20 years ago. We're almost 21 years ago. And so I think like that portability and that modularity of trading fixed income in that way was very, very new. We were sticking bonds into an equity wrapper and putting on an exchange. In a fixed income market back then, it was over the counter. You paid, a broker really large commissions if you were to buy, a set of bonds or a single bond, and it was not transparent. You couldn't see a market all lined up in one place. So the technology is critical to the growth of fixed income. And, having had experience in BondBlocks' bench of doing this in equities and understanding how you could cut up the equity market and really find different precise ways and investors would approach those and interact with, the exchange, and there's sort of a virtuous cycle of transparency and cost effectiveness. We just see that story falling in place for bonds. And if we focus on it and we talk about it and we offer clients the products that we think they need, we believe it'll grow and it'll add important efficacy in their portfolios.
Absolutely. Well, that was very, very interesting, and appreciate you, taking the time to answer those kind of, our questions here from Logically. But what we do in this coffee break is we do open it up to the audience for Q&A. We try to keep it short, so we're in good time. So we will just open it up real quick. I think I already have one coming in. Okay. And this is why I said technology, because I did see this pop up, but let's just read this question. And I think you might have answered it, but how has technology impacted the fixed income industry? And what do you think the future holds in terms of further kind of AI or tech advancements in fixed income? Is there anything you can add there?
I mean, AI is going to be part of every platform that exists. I think what's happening is the trading platforms are becoming a place where you can go and interface with a lot of different brokers at once and see your trading. And those platforms are every single quarter creating brand new products of the way that you're going to be interacting with a fixed income trader or the fixed income markets. And of course, like AI is going to creep into every OMS and every market surveillance part of technology that there is. So I think what's more important is being able to see something in one place and have infrastructure for trading that is similar and can also be overseen and is fair, and that's increasingly accelerating in fixed income. So I did kind of cover it, but
yeah,
it's digitizing for something that used to be a voice broker and and about relationships and didn't have as much transparency as it could have.
Absolutely. Okay, we have another one. Okay, so in your opinion, what are the most important factors to consider when evaluating a fixed income investment opportunity? Is it yield? Is it maturity? Is it credit risk? Is it
that's going to be specific to everybody's vantage point and with their advisor or if they're a portfolio manager themselves, with like what their mandates are and their objectives are, of course. But I think what's important for what we would say at BondBlocks is more interesting to consider now is the ways you can get access to risk factors, duration. You can manage sort of your exposures to yields in a more precise way. We've cut up the fixed income landscape so that you can now see the energy sector and high yield. The energy sector and high yield is not like the rest of the broad based high yield market. It's the most volatile, so in good times and in bad. But right now, it's had an incredibly interesting 18 months. It actually has been outperforming other sectors in high yield, and being able to see like a different cut of different areas in fixed income, I think is incredibly important, because there aren't a lot of investors that follow, more precise exposures in fixed income. So we hope that our products sort of shine a light on that. So when I think about like what factors you should consider, I think it's more like you should be looking at the different ways that fixed income is performing, and you should have a set of tools that help you see that on a regular basis, track it and look at it. Most, I think, investors or clients end up getting their fixed income exposure from a fixed income manager, a portfolio manager of a mutual fund or of a private credit fund. And it takes a lot of explanation for you to understand what's in that portfolio and why they chose that bond. And it is a big value add service. Those funds are, managed by active and professional managers that have invested a ton of research into their portfolios. But it takes a lot for you to track that and follow it and understand it. And I think that should be easier for you going forward. So that's why I say when you think about the risk factors, I think you should just start with like, why don't you get to know the different segments of fixed income and see how they relate to each other first, and then consider, the next step. But for this year, if I were to say anything for anybody, you really should put your cash to work. If you're concerned about, you still can't make sense of what's going on with the economic situation or what's ahead of us in terms of inflation or rates reducing, or when the Fed is going to stop hiking rates, you could probably just hang out for a time being in the shorter end of treasuries. And while you're waiting to make your decision, you're at least getting paid to do so. A year ago, you didn't have rates at these levels close to 5%, mid fours in the 6 month and the 1 year treasury. And, while you're waiting and you're not sure what to do with your next step of investing, like at the very least get paid for it, because you can now.
That actually goes kind of to another question. And this is, what are the pros or cons to investing in target duration bond ETFs versus just buying treasuries directly?
So we created the target duration ETF so that you could see your interest rate risk on the label, so that you could understand that you're buying a discrete exposure to interest rate risk. In other treasury ETF products, it's a maturity range, 1 to 3 years, 0 to 3 months, 7, 10 plus. And those durations, they vary over time. And so you may be picking up, if you're using treasuries to manage your interest rate risk, you may be picking up additional risk that you can't really see very well. So the first thing we wanted to do is put the duration and /interest rate risk on the label. So our products, target a specific duration. So you're getting a 1 year duration if you buy X1, or 6 month duration if you buy X. That's the first step. The other thing we wanted to update in treasury space, which I think just hadn't been updated in a while, was the price. So we wanted you to keep as much of this income as you can. And, the institutional price for trading at treasuries is not 15 basis points. It's much lower than that. So we brought the price down on the shorter end of the duration products, down to 3 basis points. We wanted it to be something that like was very easy to access, very cost efficient, and super simple. So I think like being more precise with this type of risk factor, especially in this last year where you're facing a lot of interest rate changes, was paramount, was the first improvement we wanted to make and differentiate from. And then obviously it's been very cost effective, because it's been 20 years since anyone's updated that price. We thought that was probably overdue.
That's great. I hope that answers that question. And I think we've got time for one more I have up here. How do you see the fixed income industry responding to growing demand for ESG focused investments?
Yeah, we don't have a capability in ESG at BondBlocks. We haven't really dipped our toe into that need with our clients yet. Never say never. If a client sort of just expresses that they need a different version of what's out there. But I think there's just so much data that can be applied to bonds, and sometimes is really equity research data or is related to different aspects of equity. But I don't think we've seen anything to date that's really compelling in fixed income for us to, create a precise exposure for, and that's what we do at BondBlocks. But I think that it's interesting how the data is being applied, that sort of started out as equity research and being applied into fixed income land, or different types of issuances of bonds are being considered more on the E side of the ESG. But in totality, I think we're really in the early days of applying this to fixed income.
Well, great. If there are no more questions, I hope that this discussion has provided you with a behind the scenes look into BondBlocks. You're able to walk away with some great insights regarding the future of the fixed income industry and what's to come from Joanna and her team. So Joanna, are there any thoughts you want to leave us with before we sign out?
No, just thanks for having me, and I really appreciate the discussion.
Absolutely. Thank you so much. Thank you everyone for joining, and have a great rest of the day.